companies that can get financing don't need it, and then when companies need financing, they can't get it.
Hello everyone, thank you for watching. Today I've got Brad Kiendl from Ashdown Capital, and what Ashdown Capital does is they help companies raise the financing they need to grow their business. So where Crownsman is building out strategies or business plans or working on efficiency, Ashdown's actually getting the money together for them to grow. So what I want to do is I want to just go through this interview. First of all, thank you for joining me.
Thanks for having me.
And I just want to go through questions that I, as a business owner, would obviously have, and what I think other business owners would like to know. And so the first question is, I think that we all are dealing with, is what is the biggest hurdle when companies are trying to raise capital or get financing for their business?
Yeah, I mean, the old saying in banking is companies that can get financing don't need it, and then when companies need financing, they can't get it. And while that can be the case in sometimes, it definitely presents a challenge that often when businesses are looking for capital, it's because they're growing or they need something specific. And in that instance, it can sometimes be tough to get the capital to find the financing to do it. A lot of the time, the reason being that banks and traditional funding sources, they look at the past, so they look at financial statements that sometimes are a year old by the time they're in front of the bank. So they're looking at the past for, financing for something that's in the future, if that makes any sense. So it can present challenges.
Right. And what for companies that are trying to grow, how would I ask this? If you're trying to become more efficient, let's say you're a manufacturing company that's trying to update your systems, as opposed to a company who's trying to expand into the Asian market, what is the bank friendlier to? That sort of that aggressive expansion, or a company who's just trying to be more efficient with their current revenue?
Right. I mean, we can look at that question in two ways. I love it because, we love working with companies that are trying to become more efficient, because often a big piece of efficiency is cutting down costs. Mm-hmm. And financing costs, bank interest and bank fees is traditionally a big cost that shows up on an income statement, where we love to step in to help people find, negotiate better terms, etc. But the banks do appreciate businesses that are becoming more efficient. They compare one business to another business all in the same industry, and that's their scope of what type of risk rating and what type of pricing they want to give on those businesses. They'll look at the margin if it's a manufacturer, so one or two or three manufacturers in the same industry manufacturing similar products. The company that's the most efficient obviously reports the best bottom line, makes it a lot easier to get financing. They love financing growth. We love financing companies that are growing, because that shows it's a good, healthy company, that what's hurting them from getting the financing or what's hurting them from growing, is the lack of access to capital. So we love stepping in and helping good, growing companies get financing. But a lot of the times the banks will look at it and say, oh, you're growing out of your means, or you should be putting in more of your own cash, or mortgaging your own house to take on this project. Right. So we like to structure things and work with clients in a way that when we present it to the bank, it's in the best light possible for the bank, so they can really understand the deal and make something happen.
So are you typically going to one bank, or are you kind of trying to split it up? How does that generally work?
So, I mean, deal to deal, it all just depends. We've got a large network of bankers, from private lenders, bankers, credit unions, the whole gamut. So in most cases, we'll be dealing with 2 to 3 bankers at a minimum, so to make sure that we're getting the best deal for our clients. And the best deal, people often turn to price, right? It's easy to say, I'm getting a better deal because I'm paying prime plus 1, where right. my neighbor's paying prime plus 2. Whereas people really need to understand that the banks, they look at price for one, but they also look at security, and they're going to look at management. The big thing that has everything to do from the bank's approval side is management. What kind of input does management have? How long have they been in place? Have they been through a few economic cycles where when things go bad, they can still get through it? So not that management is something you're going to alter when you're going to the banks, but it's definitely looking at more at, you know, structuring something from a pricing standpoint and a security standpoint, and then obviously a total like loan value amount as well.
Right. And so, out of you mentioned management, is that sort of the hidden gem that a lot of companies don't realize how important what management brings to the table is? I mean, everybody knows about you have to have assets and cash flow and things like that. How big of a role does management play in?
So management's the differentiator. In the end, it's, you know, banking used to be done on a handshake. You know, one banker would look into the manager's eyes and say, or the owner's eyes and say, is he going to pay it back? They literally say in the banks, good guy, will pay, is what it used to say on all the justification for advancing loans back in the day.
Yeah.
So yeah, it still carries a huge amount of weight. In the end, can you look across the desk at who's making all the decisions and are they going to pay you back? Are they going to have the means necessary financially, but also just in their moral character to make sure that the bank gets their money back?
Right. You know, something that we actually had a previous conversation about it was the difference between commercial banking and residential.
Yeah.
And how even business owners don't understand the difference between the two of them.
Certainly, yeah. I mean, there's a massive difference. I always say the big test for us is we can ask anyone on the street, hey, what's the best mortgage rate today for a residential mortgage? And most of the time people can estimate, you know, within, you know, 0.15%. You know, it's 3.15 and it's, you know, pretty close. Where if we ask commercially, what's the best commercial mortgage rate, or what rate should you be paying on your commercial line of credit? We ask a lot of business owners, and they don't even know.
Right.
And the fact of the matter is, it's a lot more complex. In residential, the government outlines most of the rules, and the banks, credit unions follow them. So if you can approve somebody within those guidelines, that's the price that you get. There's not a lot of wiggle room. Whereas in commercial, it's entirely priced based on risk.
Right.
So they look, again, management. They look at, you know, what security's in place. They look at how long you've been in the industry. What do the financials look like?
Yeah.
They look at a whole, you know, whack of different factors. And then price the loans based on that risk. So yeah, it's a huge difference.
So now going back to Ashdown, where you're really adding value to these deals is that if you're talking to 5 different banks, are you helping negotiate the deals? Are you guiding the customers? What is your role in that?
Yeah, so we add value in a few different ways. The easiest justification of our value is the savings we're able to negotiate for on behalf of our clients, whether it's in upfront banking fees, commitment fees, and obviously interest rate. The other value is understanding the other side of the coin, where's the bank coming from? So making sure that the security is structured right. You're not putting up your house and giving personal guarantees when you don't need to, you know, that type of thing. And then lastly, just in a timing perspective, we get involved and we basically become the conduit between the bank and yourselves as business owners. So you don't have to call 5 different banks and waste all the time doing it.
Or 10.
Or 10 or however many.
Yeah.
So we do that on your behalf.
Yeah.
And then obviously make sure that we're presenting all the information in the best light possible.
Yeah. Keep this interview short. So for more information, I think we've covered a very, like, maybe even the surface, probably not even. So where people that want to know a little more about what you do and understand where you can offer value to their company, where would they go?
Yeah, so our website online, www.ashdowncapital.ca. There's lots of information there. Otherwise, reach out to yourself, Jerrod, and you've got our contact details. I'm sure you put us in touch.
Yeah, give us a referral. It makes us look good. All right. Thank you, Brad, for doing this interview.
Yeah.
I appreciate it. And I hope you watching are finding it helpful. They're good guys. Ashdown's a great company. So check them out online. I will put the link in the video so that people can click easy to it. And we'll have another video for you soon. Talk to you soon, guys.